won't stop till I hear him say,
For the last about 20 years, the state-owned bank managed to create side accounts for essentially everybody. So now we have 90% of the population that have side accounts that are free. They are linked to your national ID number that you get 2 days after you're born and will accompany you until you die. They are linked to your national ID number that you get 2 days after you're born and will accompany you until you die.
For the longest time on the CYPRX platforms, we have been mentioning that the financial landscape is rapidly changing, mainly driven by technological advancements. One of the key aspects of this changing environment in the space is the increasing use of digital identities. Alongside the central bank digital currencies, or CBDCs, are emerging as potential replacements for traditional fiat currencies, using distributed ledger technologies like blockchain to enable faster and more secure transactions.
Do you think that central banks should try to adopt these technologies at the same speed as the private sector?
I have read the survey that the survey shows that the DLT, or so-called blockchain, is expected to be widely adopted by the financial industry. The DLT, or so-called blockchain, is expected to be widely adopted by the financial industry. Well, the new technology definitely is a very strong driving force for the financial innovation, and DLT definitely is very suitable for non-real-time, low-frequency, and less sensitive business use cases, such as registry or confirmation of property rights or securities settlements.
These developments are part of a wider shift towards the new payment systems that are being created to meet the needs of an increasingly digital world. In the next few years, these technologies, in our personal opinion, will be implemented into our everyday society and revolutionize the way that we pay for goods, services, along with how we send domestic and international transactions.
How do you now start to define it so that the innovation that we're leading is less about chasing shiny objects or FOMO-driven innovation, fear of missing out, and it's more about putting those singles on the board and really driving utility and value for the institution.
Really driving utility and value for the institution.
On what we are seeing out there, we have completed several trials and different tests with almost 20 projects throughout the last 2 years or so. And it has proven to be a very fertile ground to touch base with market players, indeed, on quite a broad range of initiatives, from blockchain, artificial intelligence, cloud computing, or biometric authentication. Some of them from the fintech community, but many from the banking system. I mean, very well established and big banks. They are really investing money on this type of initiative. So,
big banks, they are really investing money
on this type of initiative. So, I think this is really important.
As mentioned, central banks are focused on the utility and value that distributed ledger technology brings, because it has the potential to improve the efficiency, security, and transparency of financial systems. By using distributed ledger technology, central banks can reduce the time and costs associated with financial transactions, increase the speed of settlements, and provide greater visibility into financial activity. In previous video breakdowns, we have mentioned that central bankers are heavily interested and invested into this digital transformation. Based off the statistics that a very small percentage of people are actually involved in this new emerging technological landscape, a lot of people, in our personal opinion, are set to miss out on this once-in-a-lifetime opportunity to get involved while we are still early on in the stages of this adoption curve. It is critical, in our personal opinion, that you start conducting independent research, along with understanding how important it is for the public and private sector to work together on these technological innovations to ensure that they are properly regulated and integrated into our existing financial systems.
What we have seen throughout the euro area and in Europe in general is a dwindling use of cash. And this has been certainly accelerated by COVID. It has been tempered a bit during the terrible invasion of Russia against Ukraine, because there was suddenly a little appetite for cash yet again. But the general trend is less use of cash and more use of digital payments. The numbers are very clear. We have seen a decline of 72% to 59% in terms of use of cash, and the digital payment have virtually tripled during that same period of time. So everything is going digital.
Everything is going digital.
People are clearly expressing a preference for it, and there is no reason why we, as a central bank, should not be exploring also the reason why digital cash can be of good use.
We know now that the COVID pandemic accelerated the global payment landscape towards a more digitalized landscape due to the increased demand for remote and contactless payment options. Lockdowns and social distancing measures all resulted in a surge in e-commerce and digital payments, as well as a decline in the use for cash. This trend has prompted central banks to explore the development of central bank digital currencies, or again, CBDCs, which could provide a secure, according to the central bankers, and efficient digital payment option backed by central bank authorities. While the implementation of CBDCs could potentially reduce the need for physical cash, in our personal opinion, it is unlikely that cash will disappear entirely, at least for the next few years. Now, in my personal opinion, for the time being, at least the next 3 to 5 years, it is likely that cash will continue to operate alongside CBDCs, serving as a backup payment option and a means of financial inclusion for those without access to digital payment systems.
And the ability to settle instantaneously. So cash in physical form settles instantaneously, right? When you pay, the payment and settlement is in one transaction. But when you send it through a digital channel, settlement is not instantaneous. And this is where, as Christine said, what you need is digital cash to combine the benefits of digital and the benefits of cash. And that is what digital currencies do. So I think this second monetary system that will coexist alongside the first monetary system. So I think this
Second monetary system that will coexist
alongside the first monetary system will have that feature. And I think it's important from the security and resilience point of view that monetary system must mirror the structure of the traditional monetary system, two-tier system with.
Now, personally, as a consumer set to experience this new payment landscape, I'm taking several steps to prepare for the digital transformation from a cash-based payment system to a CBDC-based payment system. In our personal opinion, it is critical that you educate yourself about how CBDCs and digital payments work. Now is the time to prepare yourself for the potential phasing out of cash, and personally, I'm taking measures to ensure that I have access to other payment options.
Now, the secondary monetary system that I'm speaking about, the new one, where we built a new set of rails, and I think the BIS has spoken about a unified global platform or infrastructure. The security of the infrastructure is critical. Yep. And the design features there may well be different from our traditional RTGS and payments networks, because these are, expressed as tokens on distributed ledgers, which brings about its own set of risks, which we need to be mindful of.
To wrap this all up, by now you should be aware that a financial crisis or a pandemic can be a catalyst that causes a shift in the global financial landscape. But on the other hand, we wonder whether the system can be resilient if the scale of the transaction is increased significantly. What we have in mind is some uncertainty about the liquidity provision function in the system, especially during the time of crisis. And as I've said in previous video breakdowns, we are on the edge of our seats, waiting for that potential catalyst to unfold right before our eyes. By exposing underlying weaknesses or imbalances in the system and prompting new discussions and actions by policymakers and market participants, financial crises or pandemics can potentially play out and be the catalyst that sets all of this in motion. Now, crises can lead to the changes in financial regulations, risk management, practices, and economic policy, as well as changes in the consumer behavior and market dynamics. I personally believe that the next major global crisis is already looming and will issue in this new digital system, which will set a new standard for the way our entire financial system operates. So if the global or regional safety net can provide a liquidity provision function to the existing system, it can help the system as well as alleviating the so-called stigma impact of traditional safety nets, such as IMF program, for example. What I have in mind is some kind of digital version of IMF SDR, which can be programmed in advance so that they can actually provide liquidity automatically when the crisis happens. It'll behoove you, ladies and gentlemen, to take it upon yourself to do more in-depth research, to watch some of these fundamentals that are released from major central banks or the BIS themselves. As always, I hope that you all enjoyed this deep video breakdown. Many blessings to you all. Don't forget that my new book, Forever Efficient, is now available on Amazon. If you all enjoyed this video breakdown, smash that thumbs up button and subscribe. We do appreciate the love and the support. As always, this is not financial advice. I'm not telling you guys to go out there and get involved in cryptocurrency. Just do your due diligence, do your research. As always, be cognizant, be aware, and I will see you all in the next video breakdown.
I won't stop till I hear him say,